morning, everyone, and welcome to the 87th episode of the Veritas Fact-Finding Series. This morning, I'm joined by my good friend and mentor, Al Guarino. Good morning, Al.
Morning, Anthony.
Great to have you on.
Thank you. It's my pleasure.
Surfacing facts and revealing truths is a never-ending quest for us at Veritas. In each episode of our fact-finding series, we go on the ground to speak with industry professionals in an unscripted, candid video format to discover how we can make better investment decisions. In this series, and in everything we do, we believe that facts empower investors and that better information leads to better investment decisions. By way of background, my name is Anthony Scilipoti. I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada, and I'm proud to say celebrated 20 years being 100% employee-owned and operated. I have a quick note of a disclaimer. This broadcast is not to be taken as investment advice, and participants or employees of Veritas's group of companies may own securities discussed in this broadcast. While we love all our guests, and Al, of course, in particular, this session may contain forward-looking statements, investment opinions, and comments that we do not agree with or potentially at all. And another interesting point is I'm on a land standing today is the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, and the Haudenosaunee and Wada peoples, and is now home to many diverse First Nations, Inuit, and Métis people. I also acknowledge that Toronto is covered by Treaty 13, signed with the Mississaugas of the Credit, and the Williams Treaty, signed with multiple Mississaugas of the Chippewa bands. And now I'd like to talk to you a little bit about Al. So Al and I met. Al was the head of Arthur Andersen's owner-managed, or at the time it was called Enterprise Group, back when I started at Arthur Andersen in 1994. And he was I guess he was a partner of them, and you ended up heading that division in 1998. And then essentially after 20 years, having worked as an accountant, you also graduated from U of T at Commerce like I did. And we also went to the same high school, imagine that, at St. Mike's. But since then, you've taken on and have purchased a wide variety of businesses. And I think at last count, you told me you're around 14 or 15. You employ in excess of 500 people. And you're on the board of a company, a technology company on the Venture Exchange, where you're also the chair of the audit committee. So I think when we get today, what we'll talk about is buying and managing businesses. What are the things you look for? What are the key things? Because I think that resonates with us as investors looking at public companies. You know, we think it's different, but it's not different. We have to think about it the same sorts of ways, looking at those same sorts of indicators. Then I think given the timing, it'd be great to hear your perspective on, you know, how to manage a business during this time of stress caused, of course, by the war situation. And it'd be great to hear. I know we've been in touch over the last couple of years, and you trying to manage your businesses during COVID. So why don't we start off, Al? What brought you into getting into accounting, and then what turned your attention into becoming an entrepreneur?
Well, it was a long story to get into accounting. I was originally in med school. And when I realized that I didn't have the stomach for medicine, once I got a little bit into the weeds, I went back home and said, you know, I got to do something that I can use my head, but not necessarily be involved in the more squeamish side of medicine. So accounting seemed to be something that hit all the buttons for me. And in fact, I never regret that decision. I thought that accounting and my experience, I mean, perhaps my path was, you know, a little bit more fortunate. I worked with some of the best accountants and advisors in some of the best firms in Toronto for many years. And, you know, they took a shine to me and they were my mentors. And I felt that the experience that I got working with these individuals and watching them manage their clients and help their clients through good and bad times was invaluable. It was an experience I'll never trade. It was stressful. It was difficult. You learned every day. You never knew what to expect. But it's far from what I think the average person might think an accountant is. You know, our area of practice, we helped our clients grow. We helped them through difficulties. We helped them through opportunities. We helped them through acquisitions. I mean, we did everything. It wasn't just accounting and audit. But the disciplines that accounting brought, I found once I did leave accounting, have been invaluable. It's, our ability to think analytically, to spot opportunities, to spot trouble before it really gets too serious. All of those things, I think, that are so invaluable to an entrepreneur when you finally step out there and you move on and start running your own business. I had said that I would spend 20 years in accounting. That was sort of my career path. And it was exactly 20 years when I left Arthur Andersen at the time as the managing partner. And since then, I enjoyed my clients. And in fact, I'm still either on an advisory board or I'm actually on a board or still in touch with many of my clients. But at that point, I felt, I've done enough. I want to build something for myself and my family. And that was in roughly 2000. So, 20 years later, I do have 14 companies and approximately 500 employees. And, if you look at it from the outside, they're all very, very different businesses, which, gets me to really the point that I really want to make today is that I believe if you have entrepreneurial skills, if you have analytical thinking, if you are disciplined, if you are able to manage your human resources and get the most out of them, you can run any business. I don't care what it is. I have manufacturing businesses, distribution, healthcare, collision repair centers, restaurants. I mean, it's the entire gamut of what our Canadian economy is, and we run them successfully. And it's again about applying the same principles to that business, regardless of the business that it's in.
Why don't we dig into some of those principles and things that you look for when you're looking to buy a business? What are some of the key things that you look for?
Well, I guess I could be called a value investor, but value is defined in many different ways. Sometimes you pay for a business, and you might pay for a business that we would consider to be at the top of the market value, but there's value in that business over and above the financial aspect of it. First and foremost is the HR team. Are they being utilized to the maximum? Often I'll find that a business has tremendous people, just not been given enough room to grow and help manage that business. So there's value in that team. Sometimes you look at a business that's really lacking a succession plan. So you've got the owner and founder, they've grown the business and they're slowing down, and they haven't been able to transition the business management to their team properly or as efficiently as they can. And that's, again, another wonderful opportunity because we are the transition plan. We walk in there, and typically we keep all the employees that are there. Very rarely do we let someone go. And usually it's because in these types of opportunities, the employees that are there haven't been utilized to the extent possible. The third thing is reputation. I found that any business, even if it's poorly run internally, but well run from a market perspective in terms of reputation, has big opportunity. But if it's, if the market reputation is down in the dumps, it takes a lot of time and a lot of investment to grow. I'll give you an example. I bought a collision repair center in 2014. It was doing just over $1 million. Had a wonderful reputation, but its internal processes were terrible. Didn't even have a website, didn't do any training with its employees, but miraculously delivered good product and service to its clients. 7 years later, we have 2 locations, working on a third. We're over $10 million with the same employees that were there before. So change can happen really, really quickly. But if the reputation of the business from a market perspective is poor, that's it's a tough way to go. And then clearly, we always look for synergies. I don't like to call it cost management. It's about eliminating waste. So businesses that have been around for a long time, typically with the same ownership group, tend to get a little bit lazy in terms of the way they look at their expenses and the way they look at where they invest their people. So there's usually opportunities to remove inefficiencies without firing people. I mean, it's typically just waste that's in the system. And I think that's, something that we always bear in mind when we look at a business. Is there going to be an opportunity to help defray some of the investment costs, because we know we can be more efficient while still delivering the same product and service at the same level of professionalism. The other thing is, probably lastly, is that, what's the market that they're operating in? If you're operating in if that business is operating in a market that's very fragmented, has a lot of smaller one operation, two operation businesses, there tends to be an opportunity in those markets because everyone started doing their own thing. And inevitably, someone a little smarter or with a little more business savvy will come in and start to consolidate. We've seen that in the collision industry, where when I got involved, that was one of the reasons why I got involved in it. And now you've got massive, 7 or 8 years later, you got massive chains.
TD's even in it.
Yeah, that's right. TD Bank has gone into it. So it's brought the professionalism up. And fortunately, I got into it just prior to the consolidation. So, the value of our business has grown dramatically just because of this push towards consolidation and professional management. Same thing happened in my clinic business, where, it used to be all, one doctor, one clinic, or one physiotherapist, one clinic. We happen to be a group of 29 clinics, and we were sort of in the leading edge of that. And that consolidation has really helped us grow our business, because now we are looking at more and more opportunities to acquire or to mentor or to grow with sole practitioner type clinics that have realized that they just don't have either the resources or the HR or the strength to fight it out on their own. They want to join a group that has already figured out what to do. So those are sort of the key areas that I look at when I look for a business. And frankly, many times, we walk away from deals. I probably walked away, I bought 14 businesses or grown 14 businesses, but I probably walked away from 20, where there was always regret in terms of, well, should I've, tried a little harder to get it? But, you have to make a decision. It's got to feel right at the moment that your business is at. You don't want to jeopardize your business. You don't want to jeopardize the resources that you have, or invest too much time and money in a business that's going to need too much time and money and distract from your core mission, which is your existing business.
If you, I've asked you about this sort of thing always. If you had, these are the 3 or 4 or 2 or 1 key questions that I ask when I'm looking at making a potential acquisition of a company. What would that be?
Reputation, for sure, is number 1, and it's just the quality of management. Those are.
The problem is assessing that quality of management is difficult.
Yeah, it is. But once you get in there, you can realize, especially when you talk to some of the senior people in the company that aren't the shareholder or shareholders, you start to get the sense that they feel like, they could be doing more, but they aren't doing more. You can look at things like, geez, are they social media savvy? Well, they don't have any social media presence. Well, in today's world, if you don't have any social media presence, you're probably undermanaging your business. If the same people have been there and you're not able to attract new blood into your business, that tells you that it's a stagnant business, that you can grow it. So, there are clues that you can get fairly quickly into your due diligence that tells you if the business is undermanaged. And that doesn't mean badly managed. Mm-hmm. It just means not managed for growth.
Almost, you see, what it does is it creates an opportunity. And it's always, when you're making an acquisition, it's not only what you see, but you have to be able to look past what your eye can see and say, okay, where could it be? And what are the challenges to get there? Right. So let's now talk about the crisis. And it's amazing. It seems like we're going from crisis to crisis, right? So you just went through COVID, where, unfortunately, you had to shut, you're getting the auto collisions are way down. So no one's driving. So lines demolition, nobody's coming in, right? And so you have to deal with that. You're having hard time getting parts for some of the manufacturing business that you have. So how did you weather some of that? And what has that taught you about where we are today, looking at the war and the impact that it's having? And what are some of the things that you've done?
Well, I think in a time of crisis, let's step back a bit. Being an entrepreneur means making informed decisions nimbly. What I find is that often, the old saying, analysis or paralysis by analysis, where you spend so much time thinking about something that the opportunity either diminishes or goes away. Mm-hmm. If you want to be an entrepreneur, you just need to figure out how to be more nimble in your decision making. And to me, being nimble in my decision making is bringing in my team that I count on, and we actually put the facts on the table. Like the real facts. We don't hide anything from our team. So, in my clinic business during COVID, we were actually required to shut down. Mm-hmm. So, you can't hide that fact. So now we know that we're shut down for a few months, or, we didn't know at the time how long it would be. Well, what are the things that we need to do? How do we manage our people? How do we make sure they can pay their bills? How do we, we don't want to let them go because these doctors are very hard to get back once they're gone. So what can we do to at least survive and put that all on the table collectively and make quick decisions? In the clinic business, we moved aggressively to online healthcare. And it started slowly. I mean, the first few weeks it was slow, but by the end of the pandemic, we were doing more consultation online virtually than we were in-house. And now, it's become an everyday part of our business. But that quick decision to, figure out how can we still service our clients? How can we still bring in enough revenue to at least keep the doors open in terms of being able to pay our people and provide service? And that was very, very quick within a matter of weeks. We actually, in 2021, throughout the pandemic, actually did better in 2021 than we did prior to the pandemic. And again, it was about this quick transition. In the Leon's auto body, which again was massively impacted by COVID, we went from doing 100 cars a month prior to COVID to the first month, which would have been just after March, April, I guess, of 2020, we got 4 cars in. And I've got people that I'm paying $150,000, $200,000 a year to that are, very highly skilled techs. I cannot lose these people. I cannot send them home. Mm-hmm. I just cannot, because you cannot replace those skills overnight. So in that case, we said, well, we're not going to send people home because we can't risk losing them. So now that we know that, how do we deploy these resources? So we went on a training regimen for all our people. We enrolled them in all the courses that we needed them to upgrade their skills to an even higher level, where all the other collision centers shut down virtually and sent everybody home. We invested in our people and started training them. We actually built a new collision center. Well, we said, well, we got nothing to do. Let's build a new collision center because we were already at capacity pre-COVID. We restored all of our equipment and paint booths in our existing facility. And we applied and worked towards our Audi certification, which we got last week.
That's right.
So all of that investment in 2020 and 21 that would have been what you would have called sort of dead money, because we were paying these highly experienced techs to not work on vehicles, actually helped us because we upgraded their skills. They're now all Audi certified, they're Tesla certified, they're virtually certified for every brand. And coming out of COVID, we are one of the best positioned collision repair centers to take on the new business that's going to come at us. So different philosophy. Yes, it costs money, but we were prepared to live without any profits through the COVID years, reinvested back in our people and position us in a better spot.
Well done. And I think that's interesting, the ability to be nimble. And, even Warren Buffett says, too much IQ it can kind of get in the way.
That's right.
So you have to be able to make decisions. And I think that's the biggest problem that we have, even as investors, right? You're inundated with information. So here we are, and you're looking now at the current situation, which is the war that's happening in Ukraine. What are you doing currently, and what are some of the things you'd be looking for if you were even looking at buying a business to see that they were doing a good job managing this current situation?
Well, the war has had many impacts on many different businesses. I think the one common theme would be the supply chain. And we found that, some of my businesses rely on the supply chain dramatically. I mean, the healthcare is a little different. That is all contained within the province. But when you're looking at whether it's collision repair centers, trying to get parts from overseas, which most of the parts come from somewhere other than North America, or our factories, which buy most of their steel and aluminum and raw materials from the Far East, all of those things have started to really tighten up on our ability to source products. So early on, we were doing this already through COVID. We started estimating further out in advance what our requirements would be, and placing orders. When we would typically place orders for product 4 to 6 weeks in advance, we've now been placing orders 4 to 6 months in advance. Mm-hmm. And another part of that is also the communication with our suppliers and our customers. In our manufacturing business, we've been communicating on a weekly basis, letting them know, hey, if you need, 100,000 pounds of steel that you want made into some certain product, you can't call me today and expect to get it tomorrow. So, we were actually coaching our own customers on extending their planning timelines so that we can better position ourselves to service them, to make sure that we don't fail them. And that took a little bit of time to come around, but they have come around. Now that the war has hit, that's accelerated even more. So we're actually dealing with the possibility of shortages, where we're just not going to get them even when we have. So now we start talking about, are there other avenues? Can we go to other markets? Can we, recalibrate the orders? There's a whole bunch of other things that you try to do. It's certainly not easy. And, and the other thing too, is that your pricing is changing dramatically. So before we used to have quotes for 30 days or 60 days. Now they're 1 week. They're 1 week. It's that bad. This price change, especially in metals, the price changes are rocketing every single day. You quote today, and by Friday you're underwater with the pricing.
This is for the HVAC business, or which one is this?
Well, one of my plants is Mex Precision. We do stainless steel predominantly. We have a 50,000 square foot plant servicing. Our biggest clients are in the food industry, and they would normally order 4 weeks ahead of time, but now they just can't. So we're working with them on their expansion plans and their growth. And okay, well, what do you need 6 months from now? Mm-hmm. Well, I can't really tell you, but I have a feeling this is what I might need. Good enough for me. As soon as I know that that's where you might be heading, I'm going to start planning for that. It's really tough, but if you don't, you're going to have a very, clients, as much as they understand the war and the supply chain issues and COVID, they don't like to hear that you don't have answers.
Correct. And I think you didn't touch on this, but you said indirectly it stands to this. You mentioned that you reinvested when you instead of shutting down, you invested in your people, which is your key asset that fixes the cars. They don't fix themselves, and right. So that requires balance sheet. So we focus heavily on the work that we do when we're looking at companies. Is what's on the balance sheet, what liabilities are not there, what are being understated, et cetera. Are those assets really able to be turned into cash? Because when it's they say when it's a rainy day, if you don't have that ability, you just can't act. Never mind be nimble. You can't move.
Yeah. Again, the importance of your relationship with your finance community and your, the banks and everyone else is that over the years, you build up a reputation of honesty and integrity, and whatever you tell them is actually what's happening, and then they get a sense of your management skills, and they understand that COVID was a curveball that nobody could expect. The war is a curveball that I don't think many people expected to happen so quickly. But the bank has faith in your management team, and they have faith that you've got your business under control. In fact, through COVID, most of our companies were offered bigger lines of credit than we had before, even without asking. And the banks came and said, look, we have faith in your management team, regardless of the business that it was. If you need more, tell us what you're going to use it for, and we're prepared to help you.
It's actually a very interesting piece of due diligence that I'm going to take from what you just said. We'll talk to, let's see what other investors are saying. Let's see what, peer competitors are saying. Well, what about trying to get you dealing with XYZ bank? How about we try to interview the banker and find out how that relationship stands? Because that's key. If that's a key lifeblood to the business, that's going to be an insight that you're not going to get from a competitor. You're not going to get from a peer, etc. I want to remind everybody, this is a live show. So if you have questions, please, by all means, type them in. Got a great question here. It kind of ties to what we had been discussing, Al, coming in from James. So thanks, James. Al, you mentioned you have walked away from far more opportunities than you have accepted. Is there a theme amongst those that you decline on? Is it something tangible like revenues or margins, or intangible, goodwill, composition, morale, staff, that leads you to walk away?
Usually when you're looking at an entrepreneurial environment, the founder shareholder is a big part of the management team. And in those cases, you've got to be very, very careful if you're looking at an acquisition, because if they do step away, is the team that's there able, with appropriate coaching, to run that business successfully, or is the gap that you have to fill too big? Probably in half of the companies that I walked away from, I felt that the investment in time and effort in the HR team that was there would have been significant, and would have disrupted the business without me actually having to go there and sit there, which is not what I want to do. So the time and effort to get the team up to par, and the disruption and loss of business and everything else that happens. You can have a run on a company very quickly once the outside market realizes that the founder is gone and there's the turmoil in the company. Things happen really, really fast. And, that's been probably first and foremost one of the reasons, one of the main reasons why I walked away. The others could be that, the financial information wasn't really what they had provided. Once you dug into it, there were a lot of one-time charges or revenues. There's a whole bunch of other things that were there, or you find that some of the potential costs that may be triggered are very onerous. So that financial tends to be the second. The third tends to be the reputation. When you really get into it and you start learning more and more about the business, and you realize that you get into their internal records, and they have stacks and stacks of customer complaints that they're not responding to effectively, and it's really hard to dig out from unless you're in for a long, long time. You've got to be, in that case, you've got to be an expert in that business. You got to remember, most of the businesses I buy, I didn't know anything about. I mean, I bought the collision repair center. I've never even had an accident. I knew nothing about cars. I'd say today that Leon's Auto Body is probably the most respected brand in the industry in Toronto. So again, that gets back to my point about business principles, and establishing those business principles and being true to them, and you're really relying on your team and giving them the training and the voice to make themselves heard. And you'd be surprised what you can get out of the team. So those are the three things I think that caused me to walk away from businesses.
Great. Okay, everyone, if you have any more questions, please put them, just hover over the Q&A and type them in. I'm going to just launch our poll here so everyone can tell us what a great job Al did and give us some feedback for future presentations. I'm going to leave with one last question I always like to ask to our entrepreneurs. You touched on it with the concept of being nimble, but I know you and I have talked about this, so I know you have a little bit more to say. What does it take to be, I can't tell you how many people I speak to. It probably happens once a week. Someone says, "Oh, Anthony, you're an entrepreneur. What does it take to? I want to be an entrepreneur. I want to do this. I want to work for myself. I can't stand working for whoever I'm working for." If you had to give some advice to someone who's considering being an entrepreneur, what does it take to be a successful entrepreneur?
Well, in terms of being nimble, I think first of all, dealing with facts, not emotion, because the entrepreneurs tend to make a lot of decisions based on emotion, and that's a mistake. Deal with facts and seek counsel with your trusted team members. And if you don't have trusted team members, shame on you. You should be building a management team that you can rely on. So to me, being nimble is you deal with facts, you consult your trusted team members, and ultimately you're the owner or entrepreneur, you make your decision, but at least you're making your decision based on reality and based on counsel and based on facts. And that, inevitably those facts don't change very, very much over the next week or two. So, why is there the delay? Make your decision. And if you're uncomfortable with the decision, you go with your gut, which is usually right.
Okay. And the gut only gets trained over time and listening to counsel. And then at some point the analysis is done and you just jump and you say, okay, I made a decision. And you got to move on.
Yeah, it either just doesn't feel right or it feels right. And you've got to be prepared to, maybe you didn't do the right decision or you overpaid, but you still got an opportunity to pull it out of the fire. You have to be committed to that. But there's no certainty that every decision you make is going to be 100% correct. But at least you've made it properly. You've made it with real facts, with real counsel, with a good understanding of the business and the environment that you're in. And if that's the case, you're more than likely going to make the correct decision.
All right. Thanks, everyone. And thank you, Al. Continued success, and thanks for your support.
Thank you very much.
Stay strong, everyone.